seem to dominate the headlines, of course. My next guest says non-U.S. equities that sell globally are still attractive. So let's bring in John Petrides. He's portfolio manager at Tocqueville Asset Management and joins us today from New York City. Thanks very much for joining us today. We know that the second term has come a little bit differently as far as tariffs go compared to the first term. John, I'm just wondering what you see as the differences there.
Yeah, well, I think, during the first term, President Trump did not run on tariffs. It was very much his agenda then was a tax cut. And he didn't introduce tariffs until 2018. So I think your starting point in the first term was very dramatic than the second term. And it's also why I don't think the market is reacting as aggressively this time around, because A, you're not starting from zero to new tariffs. You're starting from a point where there were tariffs already in place, specifically for the Chinese, to an ongoing story. And I think the world is more understanding, or investors are more understanding that of Trump's use of tariffs as a negotiating tactic to get what he wants.
That being said, we had the American confirm just a short time ago that, yes, the tariffs are coming into play. We are seeing the markets respond and react, go further into the red. What do you think that Donald Trump learned in the first round, in his first term doing this? What did he learn there that he is now going to apply?
Well, I think he got a response the first time around. He definitely negotiated during Trump 1. He negotiated some commodity deals for U.S. farmers and things like that. But I think this time around, the question is, as you just mentioned, the tariffs will be implemented. It's not. I think the big variable here is the time that tariffs will stay. It is not 100% certain that these are tariffs that will stay in perpetuity. If the tariffs only last a few weeks and the tariffs that are being placed gets a response that to some sort of to the end party to the negotiating table, and Trump is able to work out a deal of what it is he's looking to achieve, then the tariffs can go away. But the longer that they are in place, the more impactful they will be to global GDP and to companies' earnings. Now, if you're a CEO of a company, at least since November 6th, it would be smart to have a contingency plan in place for tariffs. I would assume most companies have had some sort of strategic discussions on what would happen if and when tariffs were in play. That's what I would be doing if I was a CEO of a major company.
Okay, so what does the pain point look like if we take that scenario where the Trumps are in play, they're in play for a few weeks, if not a month or two, so Donald Trump gets, a leg up in another way. Maybe he wants to get back to negotiations, reopening the trade deals. What's the pain point for the American consumers in that time?
Inflation. If inflation starts ticking up higher, and the narrative goes louder that tariffs are a reason why inflation is higher to American consumers, that would definitely be a pain point, not only for the U.S. economy, but for the Trump administration, because running on bringing down inflation was a major campaign promise. Now, look, you have to understand this, in theory, as of right now, legally, is the only term that Trump could run for, right? The next 4 years. That's it. That's his term. And then in theory, under current law, he's out of office. The Republicans have a very small majority in the U.S. Congress. And usually the midterm elections, it is rare that the incumbent president gains seats in the midterm election. So he knows that he's got a 2-year window from now until 2026 to pass through his agenda. So that's part of the reason of why he's come out of the gate so aggressive with trying to address his policies. So he's going to push hard in the beginning to get what he wants, because he knows his window is not going to be open for that long.
Okay, so let's talk about investing. If you're an investor and North America and China are sort of caught up in this tariff war, where do you go?
Yeah, so I think, first of all, within U.S. stocks, I think the healthcare sector is very attractive. I think there's a lot of fears out of the uncertainty of RFK Jr. and what he may or may not do to the healthcare sector. So I think I think there's a lot of mispricings going on where you can find very high quality companies with, especially particularly in pharmaceutical stocks, where you're getting big balance sheets, paying a dividend, good cash flow, dominant market share positions. So I think that's one play. I think med tech device companies will be able to pass through pricing if there are tariffs. And particularly if there are retaliatory tariffs, if the U.S. companies are selling into China. I think they're going to be able to navigate through that like we saw in Trump 1. So, I think healthcare was one of the worst performing sectors last year. So I think you're coming off a very low base.
All
so
right.
I think U.S. healthcare stocks are attractive.
What about when you look at ETFs?
Yeah, the Vanguard Healthcare ETF is a simple way to play that. I'm refrain from pitching individual stocks, but for compliance reasons. But getting broad-based healthcare exposure, I think is an okay way to play rather than buying the broad U.S. Market. I think those that are buying passive ETFs, exchange traded funds on, say, the U.S. stock market right now at current valuation. I don't think that's an attractive investment opportunity. I think you can buy broad-based, European stocks or international, large cap international abroad, outside the U.S. In Europe in particular. I think the discount to domestic U.S. is very attractive.
All right, I've got to leave it there with you, John, but appreciate you joining us today. John Petrides